Today we're looking at our favorite information monopoly, the master of search, the one and only Alphabet Soup, which I will be referring to as Google for the rest of the video because nobody calls it Alphabet, not even their own ticker symbol, which is Google and Goog. Google, as we know, is an advertising powerhouse, and while they do have their hand in a few other pies, they are still an advertisement company at their core. Powered by the Google search engine, alongside their dominance with the Chrome browser and the ubiquity of the Android ecosystem, Google is the pinnacle of big data. Alongside that, their recent foray into the cloud industry will cement their position as the number 3 cloud provider throughout the world, although it will likely remain a distant third place. Google, as many tech companies were, was largely unaffected by the pandemic, as people had nothing to do other than be online. After the explosive growth throughout 2020 and 2021, this past year has been less rewarding for Google. Now, with falling share prices and layoffs left and right, big tech has some big questions to answer as shareholders demand more financial restraint from them. Let's take a look at how Google has been doing by going through the numbers. Unlike some of its peers, Google has maintained its trillion-dollar market cap, hovering at about $1.2 trillion. As of late, share price has been bouncing around the mid-90s, with a 52-week high of $151 and a 52-week low of $83 so far. While Google's had an impressive 5-year run with its share price, year-to-date, like many stocks, has not been friendly to the tech giant, despite its impressive revenue and profit margins. Last year, Google pulled in a whopping $257 billion in revenue, quite the number, followed up with a net income of $76 billion, which is also an impressive number, but it is lacking a little bit compared to some of its peers. The one key strength that puts tech above all else is scalability. Tech is supposed to scale without increased operation costs. Restaurants and warehouses and stores, they all need to expand their physical footprint as well as their revenue. However, one of the biggest benefits of tech is supposed to be that you can scale to 1 million, tens of millions, hundreds of millions even, without any real additional cost after the initial development of the product. Despite that, as you can see on Google's income statement, the cost of operations increased from $35 billion in 2016 to $110 billion in 2021. Now, I don't know about you, but I don't think Google has really done anything new or different since then. Well, besides Stadia, that is. So why did their costs double? And that largely has to do with their labor force increase, which we'll get to later in the video. But besides their costs going up alongside their revenue, which shouldn't really be the case because of the scalability of a search engine, you also have the increase in R&D expense. In 2016, Google spent $14 billion on research and development. In 2021, they spent $31.5 billion on research and development. Now, I don't know about you, but I haven't seen any new Google products besides the Pixel line. The real question Google is facing now is, can it justify so much expense? Can it truly justify spending $30 billion on research and development every year? Like, that is an absolutely shocking amount. For example, they could simply buy Robinhood for that amount 3 times over every year, which maybe isn't the greatest comparison because Robinhood has not been doing too well, but it does help put into scale the amount of money we're talking about that they spend yearly on R&D. So besides what I've already said, Google's making an absolute crap ton of money. They have approximately $140 billion in cash and cash equivalents, money that could be better allocated through acquisitions or just given back to the shareholders, because Google isn't the scrappy startup it used to be. The amount of money that it spends on R&D would probably be better spent if it was given back to the shareholders and venture capitalists, and then they founded new and emerging startups instead. And I don't mean to gloss over some of the financial information, but Google's revenue and profits are really just unrivaled. Their profit margins are up there with Apple and Microsoft. The only difference is that Apple and Microsoft have a lot more discipline than they do financially. So if Google actually starts behaving like the mature, older company that it is, because keep in mind, Google is about 20 years old now, this actually means that Google has a lot of untapped potential. Through a more conservative financial management process, Google could unlock a lot of potential in its stock price. Imagine tomorrow if Google decided to start spending $20 to $30 billion on shareholder buybacks or dividends next year. Not to mention that Google finally realized they overhired and overspent on certain projects. This is going to free up a ton of money with nowhere to go other than back to shareholders. And while I don't think Google's going to give up on research and development entirely, it's still focusing on the Pixel lineup and device segment, so it can better compete with Apple, which is probably a good thing in the long run. Alongside that, they cut the extremely expensive project of Stadia short, saving up resources and increasing focus. Additionally, Google is also now reconsidering its expense with Waymo. For years, Google has pumped billions of dollars into Waymo with no real ever product in sight. Like, for the money they spent on Waymo, they could just buy General Motors. Yeah, think about that. They could have just bought General Motors and instantly been one of the biggest car makers in the country, along with GM's Super Cruise self-driving ability. If the market ever became viable, it'd be much better for Google to just buy one of the car makers that exist already. Until then, they could pocket the money away until the day might actually come where self-driving is actually a profitable endeavor. But now that we got the biggest issues carried away with Google, the rest of the business still looks pretty good. Advertisements will likely be down the end of this year and probably the rest of next year, but I have no doubt that Google will most likely recover. The digital age is truly in full swing, and search engine advertisements are still as crucial as ever to retailers, not to mention also for brand awareness. So in the long run, the advertisement space has no real concern, although it might have some contraction as businesses start to see their marketing budgets tighten, at least for the next 2 years. Google has two primary categories: Google Services, which is the advertisement and software side, including products and platforms like Android, Chrome, Gmail, Google Drive, Google Maps, Google Photos, Google Play, Search, and YouTube. And the second being Google Cloud, which provides enterprise-ready cloud services. This includes the Google Cloud Platform and Google Workspace. It enables developers to build, test, and deploy applications on its infrastructure, similar to Amazon and Microsoft. Google also has a few other smaller segments. Its hardware products include Pixel phones, Chromecast, and Google TV, and the Google Nest Hub smart display. And then Other Bets is the segment engaged in the sales of internet and television services, licensing, and research and development services. The two biggest industries they're in, advertisement and cloud, in the long run will have more growth ahead of them. These industries are not quite yet fully mature. That being said, advertisements are cyclical in nature. And on the bright side, Google Cloud is so young in such a large market, it could have a long, straight run ahead of it. So if you want a really good idea of how Google is doing, I would keep an eye on their cloud business. Because for the time being, that's going to truly prove whether not only can Google enter a new market, but can it truly thrive and prosper with the focus that it needs to. On the larger macroeconomic side, it's hard to imagine Google will break its records in 2021, at least within the next 2 years. But I think this economic tightening phase that we're going through will actually help Google. Not only will it help Google mature as a company by going through a bit of a rough time, but because the advertisement segment is going to have trouble growing, I think this would be a great opportunity for Google to triple down on cloud. Microsoft and Amazon proved that it's not only highly profitable, but also very lucrative. And with Google still being such a small player, it has a lot of room to run. It can't do too much about advertisement spending in the short term, but it can do a lot about cloud. Not only that, but the economic downturn will help free up the labor market a little bit. This is great for shareholders, not because Google will pay their employees less necessarily, although they probably will overall, but this means they probably won't dilute shareholders as much anymore. Not only is there less competition for workers, but because of their share price being slammed, it's less lucrative to use that card. So in the long run, I actually consider this economic downturn a huge win for Google. It'll teach them to be more financially conservative overall, being more strategic with its spending, and allow them to look internally at the workforce they already have, rather than constantly fighting for every employee available like they were before. And I don't mean to romanticize what's about to happen. Google's going to cut back on a lot of departments, they're going to cut back on a lot of projects, and they're going to cut back on a lot of research, which means a lot of people are probably going to be laid off. But Google's employees are paid hundreds of thousands per year, and the skills they have will prove valuable elsewhere, even if they do have to take a little bit of a pay hit for a while. I don't think most of those people will be unemployed for long. So let me know if you think Google's going to come out of this economic downturn a little bit more mature, a little bit more wise, and a little bit more focused on its core business segments. So let's try to summarize Google. They're an advertisement juggernaut that makes hundreds of billions per year. They are now the third largest cloud provider, although still pretty small in a very large industry, one that is still growing year over year at a healthy rate. The advertisement business does face some cyclicality, as marketing budgets are always the first to go in economic downturns. That being said, the transition to cloud shouldn't really be impacted all that much during this recession. And while expensive projects like Stadia and Waymo haven't amounted to anything, Google still has a massive stockpile of cash if it ever needs to quickly enter an industry. So for shareholders in Google or ones thinking about getting in on Google, I would primarily look at not Google's revenues for the next year, but instead I would look at their profit margins and their expenses. Revenue will likely be flat, maybe with a bit of a dip for the next year. But if Google can generate that revenue with less expense and an overall higher profit margin, then the next time the advertisements go through another boom phase, Google will really profit. More so than even through 2020 and 2021. Because while they won't be able to do anything about advertisement spending over the next year, they will be able to improve their operational efficiency. And that is what I'm looking for in Google. So to all Google shareholders, keep an eye on the expenses, keep an eye on the projects and research and development, and keep an eye on the future of their cloud division. But let me know what you think of Google in the comments below. And if you like the content we make, be sure to hit that like button, subscribe to the channel, and keep watching Interesting Investments.